which is mortgage rates hit their highest point since 2000.
Yeah.
By the way, real quick note out the gate, both of us started loans in 2005. Well, 4 or 5.
Yeah, 5.
So in 2000, we weren't even doing loans, and I don't even know who it was writing loans in 2000 that's still writing loans now.
Yeah.
So now we're talking about, in the industry, people who may not have even lived and written loans at this rate 23 years ago.
But Andy, were we originating loans when we had an acronym like NINJA? Right? You remember that?
Yeah, they still classify it as originating loans, but I think that it like dawned on me. I'm like, that's 23 years ago.
Yeah.
You know, and 23 years ago,
Mikey was born.
Lonesome Mike.
Lonesome Mike.
Lonesome Mike
was barely born.
Twinkle in the eye. Welcome.
Come on,
Welcome to 2023, Mikey. But I mean, look, it says, mortgage rates soared to the highest level since November of 2000, crushing affordability for potential home buyers. The average rate on the popular 30-year fixed mortgage hit 7.48%, according to Mortgage News Daily, and the average of 30-year fixed last year at this time was at 5%.
That's crazy.
So we are definitely facing headwinds, uphill climb, however you want to talk about it, however you want to say it. This is going to put immense pressure on real estate. It's obviously putting pressure inside the industry, but I think something that people overlook is the ripple effect this has on related industries to real estate and mortgage. You're talking escrow, title, appraisers, inspectors, which then can also include local plumbers, electricians, air conditioner repair people, flooring, tile. You're talking about painters, garage door repairman, like you name it. There are things that are connected to this that are going to be feeling this pain.
Yeah. Yep. I agree 100% with that. Going back to the origination on that with the whole NINJA acronym, the reason why I kind of laugh at that is because at that point in time, it was, you were barely.
I just graduated.
You're in
I just
kinder.
promoted a 6th grade going on to 7th in 2005.
So NINJA, it stood for no income, no job, assets.
Oh, it's not.
And that's what I'm saying. Is that really considered origination, right? When you're just taking a heartbeat, a heart pulse, and credit score, and you're running and you get a loan.
Good.
Like there's nothing. You don't even fill out an application.
No, it was formality at most.
But yeah, going back to this, Andy. I mean, these are just great information. It's just crazy to think 23 years ago the rates were, that low, high. I want to do here an example. I did an $85,000 annual income, which equates to $7,083 per month. And that got you with a 20% down payment. You could afford principal, interest, taxes, and insurance, a payment of $3,400. That would just put you under like a 49 debt to income ratio for conventional. Yeah. So here's the power of the interest rate. And that was at a 7.48. Okay. So we did another same scenario, but with 5.5 interest rate. That got that same person to get approved for $593,000. That's $93,000 more.
Wow. That's crazy.
So that's the power of an interest rate. That's what it does.
$500,000 at 7.48% and $593,000 at 5.5%.
5.5%.
That's a huge change.
And those are the things that we're facing right now with the rates. It's just diminishing the buying power for people. So if we have these people that are just looking, just with that quarter, 0.5%, 1%, it's just diminishing their buying power.
I think a huge advantage is if you're coming in with 20%, instead of putting down that 20%, take some of that 20% to bring down your rate, because that A is going to help you approve for more. B, your payment's going to be a lot lower, and you don't have to basically put down the whole 20. Be strategic about it, because I believe $10,000 only equates to like $30-$60 in difference of payment. So you're better off buying down the rate, because you're going to save upwards of 60 to 70, and now it makes a lot more bang for your buck if you do it that route.
Yeah, probably a much more strategic approach if you have that much cash on hand to make it better monthly for yourself.
And again, every situation is different. I want to just compare this to what the difference is in a rate of 7.48 versus 5.5, right?
So check this out, though, and something about this that kind of jumped out when I was reading this. I was like, wait, what is investors aren't seeing the kind of deterioration in economic data they expected. I was like, I know that they've been saying that. I know because I talk about this all the time on the show, but I'm like, what? Like it seems so mechanical and it seems so uncompassionate, but it is a truth that I think we're dealing with because on paper, these are just numbers, but that represents the difference of someone being able to get into a house or not.
Correct.
And that I think is a real sad story. That's a sad state of where we're at right now.
Yeah.
I feel the Fed's taking the stand like, when you're in a scary movie and the bad guy's chasing you and then they hit him and then he falls and then he's kind of dead, right? But everybody's like, okay, good, he's dead. Yay, let's go on and get our life. And then they go, walk, boom, shows up right in front of him. That's inflation. And I feel the Fed's like, no, we got to make sure it's done. It's dead. And we're going to even overkill it. And then results to what's happening.
Yeah.
Good analogy. I don't watch scary movies.
Me either.
I heard. And I think to that point that person's gonna keep getting back up again and haunting us because I think we're gonna see higher rates for longer. Is one of my other outtakes from this is noting that the Federal Reserve wants to see the same deterioration before considering a policy shift, and that shift would likely favor short-term rates first. Well, we're talking about mortgages. Those aren't short-term rates. Yeah. Those aren't your car loan, credit card loan situation. You're talking about long-term rates, which means we're probably gonna be the I don't want to say beneficiaries. We're going to be the punching bag for some of this economic correction that needs to happen for a while. And again here, the net effect is that longer term rates like the 10-year Treasury yields and mortgages are bearing the brunt of the market's negative rate sentiment. This won't change until the data forces the Fed to start talking about the first rate cut, which we just talked about on their own chart. They signaled is not going to happen until 2024 or 2025.
Wow.
Investors and everybody takes that information and takes it as negative. So therefore, course, rates continue to go up. But another thing I did see on here that caught my attention was a lot of people, well, not a lot of people, just last week, 6.2%, according to the Mortgage Banker Association, started looking into 5-year ARMs. And before I got into the industry, I watched The Big Short, and, I thought ARMs were like the devil, like everybody listens to an ARM, and it's like, why would I want an arm when I could get a leg?
Yeah.
But no, in all seriousness, once I realized how you can leverage an ARM if you understand it and actually know how to utilize it, right now, I mean, compared to the 30-year fixed, depending on your financial situation, that could be an option that could save you a little bit more of money or get you into that property that you want. But always knowing that you have that exit route, you already know how you're going to plan out to make your exit from that loan, because it's a temporary band-aid depending on your situation. It could be, a deal maker, a deal saver. Yeah. And, I thought that was very interesting, but I would just caution people that if you do take that route, understand how it works, understand, the good, the bad, because obviously, there is a risk, but then there's also a gain if you're able to utilize it and leverage it the right way.
And there is an ugly.
I don't know if you guys know, but who has the best arms in town right now is Mikey. Lonesome Mike. Yeah, Lonesome Mike with the best arms in town. That wasn't an
alley-oop or anything, huh?
Yeah, Lonesome Mike.
He's got the arms.
All kidding aside, this is actually a great example of date the rate and marry the home. Yeah. Because you could date that rate for a short period of time, get yourself in the house, you got that FOMO or that needs base, get yourself in. Yeah. And then you can adjust and modify that later. Yeah. The current environment that we find ourselves will not be the landscape forever, just like it was not forever in 2008 or 9 or 10 or in 18, 19 or 20. It's not going to be that way forever. Things will change. Your life will change. Your needs will change. The market will change. But the ARMs are a way to get your way in the front door.
Yep. And ARMs, it's for an adjustable rate mortgage.
Yep, not literal ARMs for those of you who want to fact check and comment. There you go.